All right, so IAS 16, property, plant, and equipment. We'll look at the scope, the objective of the standard, various definitions. The standard has given us a lot of definitions. We'll go through the various definitions. We'll also look at recognition, how to recognize an item as PPE, measurement of PPE, how to measure PPE according to the standard. And we also learn revaluation of PPE, and then the disclosure requirements of PPE. So IAS 16 is a standard that prescribe the accounting treatment for property, plant, and equipment. Anytime you hear IAS 16, PP is an accounting standard that prescribe the accounting treatment for non-current assets. And here we call it property, plant, and equipment. Property, plant, and equipment. All right. So, brief history of this standard. So this standard was established way back in March 1982. It was called IAS 16, Accounting for Property, Plant and Equipment. So way back in 1982. And this standard was actually established to replace some parts of IAS 4, Depreciation Accounting. Okay, that was approved way back in 1975. So the one that was established in 1982 replaced the one in 1975. But the most important date, as far as the history is concerned, is April 2001. That's where the National Accounting Standard Board, IASB, adopted IAS 16. So that's the most important dates in the history, okay? And from there, it's gone through a number of amendments, a number of them. So when you get a slice here in the notes, I've given you a number of them. In 2003, there was amendment. In 2008, there was amendment. 2012, 2013, 2014, there were two amendments. In May and June 2020, there was amendment. When you go to iasplus.com, they will give you all the history, right? The various dates with the amendment and what made the amendment, okay? The essence of the amendment, all of them will be indicated there. So I entreat you to go to IAS plus.com. You get a lot of insights from there. So that's about it. So the last amendment was in May 2020, and that one was with effective date of application in January 2022. And it was amended with regards to proceeds from intended use. So that was the last amendment that was made. So that's about the brief history of the standard. It was adopted in April 2001 and gone through several amendments, and the last amendment was done in 2020 May. So that's about the brief history. Now, IAS 16 should be applied when accounting for property, plant, and equipment, as I've already told you, unless another international accounting standard requires a different treatment. Okay, there are some non-current assets which does not fall under IAS 16. The treatment of them does not fall under IAS 16 because there is a specific standard for those non-current assets. So apart from those, any other non-current asset should be treated with IAS 16 guideline. Okay. So what are those that are exempted? Those that are exempted, fortunately for you, the standard has outlined all of them for you. So IAS 16 does not cover IFRS 5 on current asset held for sale and discontinued operation. So if you have any non-current assets held for sale and discontinued operations, don't treat it with IAS 16 guideline. On the contrary, IFRS 5. If you have biological assets related to agricultural activity, it should be accounted for using IAS 41. If you have mineral resources, okay,
Okay.
exploration and evaluation assets recognized in accordance with what IFRS 15. So if you have any asset for exploration of what minerals, you don't treat it with IAS 16. We have IFRS 6 for you. Investment property held for rental purposes, you don't use IAS 16. You use IAS 40. So that's the exemption according to IAS 16. The standard has given you a lot of definitions. Fortunately or unfortunately, you have to know these definitions. So take note of that. First definition is that of PPE, property, plant, and equipment. What is property, plant, and equipment? What is PPE? According to IAS 16, property, plant, and equipment are tangible assets that are held for use in the production or supply of goods or services, for rental to others or for administrative purposes. And they are expected to be used during more than one accounting period. So this is how the standard defines PPE. Asset held for use in the production or supply of goods and services, for rental to others or for administrative purposes, and they are expected to be used during more than one accounting period. When we say cost, what do we mean? The standard has defined cost for you. Very soon we'll be coming across cost a lot. So let us first define cost. When we say the cost of PPE, what do we mean? Cost of PPE is the amount of cash or cash equivalent that is paid, or the fair value of other considerations given to acquire the asset at the time of its acquisition or construction. So that is the definition of cost. This is how we define the cost of PPE. What about the fair value of PPE? When we say fair value, we mean the price that would be received to sell an asset or pay to transfer a liability in an orderly transaction between market participants at the measurement date. So that's how the standard defines fair value for us. So if you want the fair value of PPE, that is your definition. Please, you have to try and then get all of them on your fingertips. All right. When we say carrying amount, what do we mean? It is the amount at which an asset is recognized after deducting any accumulated depreciation and accumulated impairment losses. So that's the carrying amount of an asset. Is that fine? In financial accounting, maybe you were told it's net book value is virtually the same. Net book value carrying amount is the same. And then depreciation, the systematic allocation of depreciable amount of an asset over its useful life. It has not changed. The definition away from SHS, right? It has not changed. IAS 16 only allows two methods of depreciation, and these are straight line and the reducing balance. Let me know if I'm moving fast, okay? Notify me if I'm moving fast. What is depreciable amount? The cost or valuation of an asset less its residual value. Cost minus residual value, that's the depreciable amount. And then the carrying amount to cost minus accumulated depreciation and accumulated impairment losses. Okay. Before I give you the slide, I'll make sure that the formulas have been fused in there. When we say useful life, what do we mean by useful life? The period over which the asset is expected to be available for use by the entity. That's the useful life. Every asset should have a useful life. As soon as you purchase the asset, you should determine its useful life. But as human beings, do we know our useful life? The number of years you are supposed to spend on earth. Do you know it? Is anyone here who knows his or her
No,
useful life?
please.
You don't know. It's only God who knows our useful life, right? Your useful life can only be determined when you are gone. But when you buy an asset, you're supposed to determine the useful life, the period over which the asset is expected to be available for use. The useful life will help you to calculate the depreciation, right? Another definition for useful life is the volume of output expected from the asset. Okay. Residual value. I've mentioned residual value. What does it mean? It refers to the estimated amount that an entity would currently obtain from the disposal of the assets, right? After deducting any estimated cost of disposal. That's the residual value. When you should sell your assets now, how much will you get? The asset that you are using, if you should sell it now. I mean, if you're disposing it off and you should sell it now, how much will you get? Usually, after the useful life, right? Usually at the end of the useful life, getting to the latter part of the useful life of the asset, if you should sell the asset now, how much will you get? So that is it. Somebody is complaining about the fact that they don't have light, the cell phone will go off. I'm recording it, so later on you can get access to the video, right? I'll upload it on YouTube and share the link with you. Are you okay? Can you change your name? Is that Abetia I'm seeing? Really? Change your name. Please use your right names, okay? Use your full names. I think that will help you. Good. So that's about the residual value. So somebody's saying I'm moving a little faster. Because these are definitions and you are familiar with most of them. Depreciation, useful life, residual value. I mean, these things, aren't you familiar with them already? Anyway, I'll slow down a little. Okay. If you have any concern, just let me know. Don't let me move forward. Later you tell me the whole show. Please don't do that. Just notify me as and when you have a concern. So when we say recognition, what do we mean? Recognition of an item of PPE, what do we mean? It is the process of classifying a transaction among the various elements of the financial statement. When we say recognition of an element of the financial statement, the process of classifying a transaction among the various elements of the financial statement. What are the elements of the financial statement? What are the elements of the financial statement, please?
Current assets, liability, expense, expense and income.
Expense and great. You guys are good.
Equity.
You guys are good. Please, madam, is residual value the same as fair value? No. Residual value comes in when the asset is almost of age, okay? After you are done, after the asset has reached its useful life, if you are to dispose of the asset, how much will you get? That's the residual value. The asset is of age, you are disposing it of, so how much will you get? If you are saying sometimes you don't get anything, so sometimes we call it the scrap value. Sometimes you don't get anything. That's when residual value come in. Is that okay? But then fair value refers to the sort of the market value of the assets. Of the asset, not an asset that has reached its worth. I'm already recording. Somebody is requesting to record this meeting. So what's your name? Eugene. I'm already recording. Okay, I'll share the link with you. I will upload it on YouTube so that it will be useful to other people apart from you. So please, I'm already recording. Eugene, I'm already recording, so don't request for this permission again. Is that okay, you? Eugene, is that okay? But this is the second time I'm seeing your request. Meanwhile, I've started the record. I've started the recording, so don't worry. The most important thing is that you people will watch it, so watch it. When you are giving the slides, please watch it. All right, so let's get back. So the person who asked the question, are you okay? The residual value.
Yes, madam.
Good. Please, the definition of the fair value, you don't have to forget it too. The price that will be received to sell an asset or paid to transfer a liability in an orderly transaction between the market participants at the measurement day. You shouldn't forget this. All right. So please, now that you know the elements of the financial statement, so the process of classifying a transaction among the various elements of the financial statement, we call it recognition. So the process of classifying a transaction as what? An asset. As an asset will be the recognition for what? An item of what? PPE. So the cost of an item of PPE shall be recognized as an asset if. So now I'm giving you the conditions for recognizing what? An item as what? PPE. Under what circumstance will you recognize something as PPE on the face of the financial statement? One, if it is probable that future economic benefits associated with the item will flow to the entity. By future economic benefits, what do I mean? You should receive reward from the use of the asset. The entity that wants to recognize an item as PPE on its financial statement should receive reward from the use of the asset. Again, they should bear all risks associated with the use of the asset, right? Like repairs and all those things. They should bear risks. Also, they should have control over the use of the asset. So if we say future economic benefits associated with the item will flow to the entity, then these three conditions must be met. Somebody is complaining about the sound. Is it still a problem? Is the sound still a problem? Let me know. Is it stable now? Set. And the rest. Is the sound stable or is still a problem? Let me hear from you before I continue. Yes, please. It's okay now. All right. Okay. So I'm taking it again. You can recognize an item as PPE if it is probable that future economic benefits associated with that item will flow to the entity. And by this, what do I mean? I mean, if the entity receives reward from the use of the assets, if they bear risks as well, and again, if they have control over the use of the asset. If these three conditions exist, then we say that future economic benefits associated with the item of PPE is flowing to the entity. That's one. And again, if the cost of the item can be measured with reliability. So these are the two circumstances under which an item can be recognized as what? PPE in the financial statements of a company. All right. So that's about recognition of the asset. My screen is not sharing. I believe it's showing. How about measurement of PPE? How should PPE be measured? Again, what's the meaning of measurement? Measurement of PPE is assigning values to what? Measurement of an item of PPE means assigning values to that item of PPE. So according to IAS 16, I hope you are taking notes on. According to IAS 16, about 50% of your midterm question will come from this standard. According to IAS 16, an item of PPE should initially be measured at cost. An item of PPE should initially be measured at cost. For the first time, if you are measuring an item of PPE, it should always be measured at cost. If you are measuring an item of PPE for the very first time, it should be measured at cost. Initial measurement of PPE should always be done at cost. We have initial measurement and then measurement and subsequent measurement. But initial measurement should always be done at cost. Good. What do we mean by the cost? What do we mean by the cost? Remember, we defined cost when we started. As I told you that the cost is very crucial. The amount of cash or cash equivalent paid, or the fair value of other considerations that is given to acquire the asset at the time of its acquisition or construction. That's the definition we gave for cost. But now, what's the formula for cost? Or how do we get cost of the item of PPE? Cost is the purchase cost or purchase price, right? Plus directly attributable cost plus removal cost. So this is the component of what? Cost. When we say cost, what do we mean? In future, I can give you a list of items and ask you to determine the cost of the item of PPE. So when you are computing for the cost of the item of PPE, always look for the purchase cost or the purchase price. Also look for directly attributable costs and then look for removal or dismantling costs and put them together to get the cost of the item of what? PPE. I'm going into detail as far as the cost is concerned. Remember I said purchase price. Do you remember? So the purchase price or the purchase cost, this is what I mean. All of these. The purchase price or the purchase cost include the purchase price itself, the invoice price itself, plus any import duties. If there are any import duties, if you actually imported the item or PPE, import duties should be capitalized. It should be part of the cost, right? So plus import duties plus non-refundable taxes. If there are any taxes that are non-refundable, it should be added to the cost. Minus trade discounts, minus rebates or any refunds. So this is what we mean by the purchase cost. Purchase cost. Let me take you back. Cost is equal to the purchase cost plus directly attributable cost plus removal cost. So what I just showed you is the purchase cost. Let me highlight it for you. So this component of the cost. The cost has three components: the purchase cost, the directly attributable cost, and the removal cost. So the purchase cost, go to the next slide. This is what it entails. The purchase price itself, plus the import duties, plus the non-refundable taxes, minus trade discounts, minus rebates or refunds. Anytime the supplier is refunding any amount of money to you, subtract it. So this is what I mean by the purchase cost. So the purchase cost, okay. So now I'm moving on to the directly attributable costs. Directly attributable costs. So directly attributable cost. When I say directly attributable cost, what do I mean? So here I've given you examples of directly attributable costs. In fact, this is coming from the standard. So when we say directly attributable cost, cost of site preparation, initial delivery and handling costs, installation and assembly costs, testing, professional fees such as architect fees, engineers, paying them lawyers. These people, when they provide professional service for you, the fee that you pay them, it should be capitalized as part of the cost of the assets. Borrowing costs, and this is covered by IAS 23. When you go through IAS 16, it doesn't really give you guideline as far as the borrowing cost is concerned. It rather refers you to IAS 23, right? So borrowing cost simply means that if you borrowed an amount of money to construct the asset, or you borrowed an amount of money to purchase the asset, the interest on that loan should be capitalized. So borrowing cost here shows how to apply the interest on the loan. Okay, I have to add it to the cost of the item of PPE. So that's about borrowing cost. And then cost of employee benefits arising directly from the construction or the acquisition of the asset. So if you had to pay some employees that were involved in constructing the assets here and there, the amount of money that you pay to them, all of them should be capitalized into the cost of the asset. So anytime you hear directly attributable cost, this is what we mean. In future, I've told you that I can ask you to calculate or compute for the cost of the item of PPM. I will give you a number of what items. So you have to know which of them should be included and those that should not be included. The reason I hear directly attributable cost, I mean cost of site preparation. In case you are constructing an asset, maybe you have to read and then get a site ready, okay, to construct the asset. So that's the cost of site preparation. Initial delivery and handling costs. When you purchase the item of PP, you have to transfer it from the supplier's premises to the customer's premises. That cost is what we call initial delivery and handling cost. And then, so what about agent cost? If it's directly attributable to the asset, you can capitalize it. If it's directly attributed to the item of PPE, you can capitalize it. And then installation, first time you are installing the asset, the cost should be capitalized. Testing, the first time you are testing the asset, after installing, the cost should be capitalized and all that. So that's directly attributable cost. Now let's go back to the last element. So the last element, of course, that's the removal or the dismantling cost. We are going to the last element of cost. Removal or dismantling cost. Where are you? So this is the initial estimate of the cost of dismantling and removing the item and restoring the site in which it is located. So let's say there is a structure already on the land, right? And you want to construct a new structure or a new building. So the cost of dismantling that old structure on the site and restoring it, right? That's what we call dismantling cost. The cost of clearing every structure on the land, making it ready for your new establishment is what we call the cost of dismantling. So take note of that. All right, so when I say calculate the cost of an item of PPE, this is what it entails. This is what it entails. And we need to know each of them, the components of the purchase cost, the components of the directly attributable cost, the components of what removal cost. So when you add this, and that, you get the cost of the item of PPE. Is it clear? Can I move on? Are you okay with the explanation? Please, are you okay? Can I move on? I want to hear from you before I continue. Hello, friends. Hey there. Let me hear from you. Is it okay? The explanation for cost, okay? Hello, friends. All right.
Yes.
Good. So let's move on then. Now, I want to guide you on what I mean by directly attributable costs. What do we mean by directly attributable cost? So with this cost, it brings the asset to its location and working condition that is necessary for it to be capable of operating in the manner intended by management. When we say directly attributable cost, this is what we mean. That cost to bring the asset to its current location and working condition necessary for it to be capable of operating in the manner intended by management. So all those costs, we call them directly attributable costs. So these costs would have been avoided if the asset had not been purchased or constructed. You wouldn't have incurred those costs if the asset was not, purchased or constructed. So that's directly attributable cost. So in future, when you are asked to calculate the cost of PPE, these are the questions you ask yourself. Should I include this? Okay, so was this cost necessary to bring the item of PPE to its current condition and location to make it capable of what? Operating in a manner intended by management? If the answer is yes, then include it as well directly attributable cost. In fact, this one you have to write it in your notes and you should have it at your fingertips. Because me see PPE, mesem, ubehunu, main exams, ubehunu. So when I ask you to calculate cost, this is crucial. Is that fine? Good. Now, costs that are not included in valuing PPE, what are some of them? According to IAS system, these should not be included when you are valuing PPE. Cost of opening a new factory and cost of introducing new products or services, please don't include it when you are valuing PPE at cost. Cost of conducting new business in new location or with new class of customers, don't include it. Administration and other general expenses, don't include it in the cost of PPE. Initial operating losses before asset reaches the planned performance, don't include it. Abnormal cost of wasted material, labor, and other resources, please don't include it. So for your information, whatever question I will give you in future, I'll make sure that some of these elements are in there. I can say cost of labor, and later I'll give you notes to the account. Note that the cost of labor costs include amount of money paid to blah, 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 for wasted blah, 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 something like that. So take note. Definitely, whatever question I will give you, initial operating losses will be there. So you know that it should not be added in valuing what PPE in determining the cost of PPE. Admin or general expense definitely will be part of the items. I told you that 50% of your midterm will come from the standard. So master the standard very well. I want everybody to get A. I don't want any B. The B should be the worst. Definitely you have some non-star in the class, right? So those people can get a B. But C, D, and the rest, and F is a no. So please master IAS system very well. Is that okay? Good.
Yes, madam.
Good. So you are supposed to know all those codes that shouldn't be included in valuing what? An item of PPE. Madam, what if the labor cost is directly attributed? So what I'm saying is that if any of them is wasted, okay, if there is any of them is wasted, there is any, if it's so far as it's wasted, you can't include. That's what the standard is saying. You have to calculate that portion and then deduct it. Abnormal cost of wasted time. If there was wasted time, blah blah blah. The staff were not doing anything. The time was wasted. Yeah, we paid them. It's not part of the cost of the asset. So that portion that was wasted, calculate it and subtract it. That's what the standard is saying. So Dina, are you okay? If any material was wasted, the value of that material that was wasted should be subtracted. It's not part of the cost. Any other resources that was wasted, normal cost of anything that was wasted, calculate that portion and then subtract it. Is that okay? If you see anything like this, it shouldn't be part of what? The cost of the item of PPE. Good. So I have an illustration here for you. Who will do the reading for us? Somebody should read for us. The class reader will get 5 marks at the end of the semester for free. So that's for information. If you are ready, you can read. And you'll be reading for me every day. At the end of the semester, you get 5 marks for free. 5 marks or more.
Jeffrey.
Jeffrey Trader.
Hey.
Jeffrey.
Jeffrey, a trader, purchased a computer for use in his business. The invoice for the computer, Ghana cedis, 8,900. Additional memory, 950.
So just mention the items,
Delivery.
don't mention the value.
Okay. Delivery, installation, maintenance, non-refundable sales tax.
Okay. Continue reading.
How much should Jeffrey capitalize as a non-current asset in relation to purchase?
Okay, so start work. You have 2 minutes to tell me the value of the value of what the computer. What's the cost of the computer? From this list, what's the cost of the computer? Everybody should calculate it and give me the answer. What did you get? You can type it in the chat. What did you get? $11,970. What about you? What did you get? So watch it to see the Sarpong-Danquah. Please change to your real name. Please change to your real name. So your name alone, -10, your continuous assessment. Hey, saying, please change to your real name. So change it to your real name right now. Watch it to see the Sarpong-Danquah. Come on. So most of you are getting 11,970. Did you all get that? Hello, friends. Did everybody get that? So can I move on? How did you get it? How did you get it? Did anyone get a different figure? So let's start. Computer, the purchase price of 8,900. Should it be part of the cost? Hi, friends. Should the purchase price be part of the cost? Somebody got 12,220. 12,970. More different figures. More fun, but I'm not Anyway, so let's do it together. Let's do it together. So computer cost of 8,900, should it be part? Yes, no. The purchase price of the computer, 8,900, should it be part? Yes, no.
Yes.
Okay, so it should be part. Additional memory of 950, should it be part? Additional memory of 950, should it be part? Yes, no.
Yes.
No.
Additional memory. Additional memory.
Yes.
Am I hearing no?
Yes. It should be part.
Morrison says no. So Morrison, let me take you to guidance on directly attributable costs. So the person who said no. Such costs bring the asset to its location and working condition necessary for it to be capable of operating in the manner intended by management. So with this, Morrison, should the additional memory be passed for it to be capable of operating in the manner intended by management? Capable of operating in the manner intended by management. So, Morrison, I want to hear from you. Should it be part? Morrison, you said no.
Yes, madam.
Yes, madam, it should be added. Good. I'm monitoring the chat too, so anything you type there, you'll be answerable to it. All right, so let's move on since you've all agreed that it should be part. Okay, so additional memory should be part. What about delivery? Delivery cost. Delivering the computer to the customer's premises, should it be part? Delivery cost, should it be part?
Yes.
Great. In exams, you do this alone, or I'll give you a list of items and you'll be asked to determine the cost. So you do it alone. So please be involved. We are applying the principles we just learned. So please be involved. Good. What about installation fee? Installing the computer for the very first time. Should it be part of the cost of the computer? Should it be part? Yes. Okay, maintenance fee for the computer. Maintenance fee. Cost of maintaining the computer, maintenance, repairs, those things. Should it be
No.
part of the cost?
No.
Maintenance
No.
fee, should it be part of the cost? No. What about non-refundable sales tax? Remember in the definition of the purchase cost, there was something like that was there.
No.
Non-refundable sales
Yes, it
tax.
should be part.
So what were we supposed to do to it? So let's go back to the cost. So purchase price, take a look. Purchase price plus import duties plus non-refundable taxes, plus non-refundable taxes, plus non-refundable taxes. So non-refundable sales tax should be part of the cost. Non-refundable sales tax should be part of the cost. We are supposed to add it. Madam, why is maintenance fee not part? That's revenue expenditure. So we don't have to capitalize it. Maintenance and repairs. We learned it from financial accounting that it's a revenue expenditure. Lodina, did you learn financial accounting? Do you know the difference between capital and revenue expenditure? Lodina, I need you to speak. Do you remember the difference between revenue and capital expenditure? Maintenance, repairs, those things
Yes,
are what?
ma, I remember.
Revenue. Good. That's why we are not capitalizing it. Is that okay? Is that fine?
Yes, ma.
Great. So now let's add.
Yes, ma.
8,009 plus 950 plus 100 plus 200 plus 1820. What do you get? What do you get, please? Please, what do you get, friends? So if you're getting 11,970, then I think it should be correct. Then it should be correct. So all the 11,970, give yourself a pat because you've done so well. So all those who got different figures, I hope you get it now. In future, you won't get it wrong, right? In future, don't get it wrong. So at this point, I think we can move on unless somebody has a concern. Otherwise, we are moving on. I have another illustration here for you. Another illustration here for you. So class reader, what's your full name? Can you read it for us?
Morrison Camero.
Okay, Morrison.
NKM Limited started a business providing Madam, that word I can't pronounce.
I think it's limousine.
Limousine. Okay. Limousine taxi services on 1st January 2011. In the year to 31st December, he incurred the following costs: office premises, legal fees associated with purchase of office, paint office in NKM Limited's favorite / corporate color, purple.
So office premises, the cost for office premises is somewhere 250,000. Then the cost for the legal fees associated with the purchase is 10,000. And then the cost of materials and labor to paint office in NKM's 1, favorite, and 2, corporate color. So we'll look at the favorites and then we'll look at the corporate. So everybody tell me the cost. Somebody has a concern. Please, the reader's voice is scratchy. We want a female voice. Do you agree with him or her? Anyway, You guys should decide and then settle on your reader so that next week the reader should read. If you want to maintain Morrison, fine. If you want a female, settle on that female before next week. But for today, Morrison will read. Okay, you agree on your page. So for now, let's come back to the item. Let's come back to the item, okay? And the item of premises. Let's see the cost of the premises, friends. Cost of premises. What's the cost of premises? Which of them are we adding? Which of them are we subtracting? Which of them are we ignoring? So what's the cost? Somebody say 260,300. So the person has added everything, 263. And what about you? What's the cost? You agree? Is it 260,000 or 26300? For the office premises itself, we all know that it should be part. Legal fee should definitely be part, but the bone of contention here is the what? So the painting of the premises. So should the painting be capitalized or not? That's the issue here. Should it be capitalized or not? And people think it should be capitalized, so they are saying 260,300. Others also think that it shouldn't be capitalized. They are saying 260. So what should we do? Those who are saying it should be capitalized, can you tell me why it should be capitalized? Tell me why it should be capitalized. Why should it be capitalized? Your reason. Hey, you're not giving me reason. 260, 260, 300. No, no, muchacho. Give me your reason why it should be capitalized or not. If you want to speak, you can raise your hand. Use the emoji to raise your hand. I'll let you speak. Otherwise, type it here in the chat. It's associated with the office. So you're trying to say it's a directly attributable cost. Some people are saying it's a directly attributable cost. So those who are saying it's 260,000, do you agree that the paint is directly attributable cost? Do you think the paint is directly attributable? Somebody saying it shouldn't be capitalized. Let me read the person's reason. It shouldn't be capitalized because it's a revenue expenditure and it should be treated as expense. Madam, because that's company's corporate color. So, it shouldn't be capitalized because it's an expense. Timothy saying. So we have favorite color and then corporate color. You have to capitalize it. If it's the corporate color, they have to paint it in the company's corporate color. Let's take an MTN or Vodafone. Hey, now Vodafone, what do you call them? Is it tele what? Telecell. So let's use MTN. What's the color of corporate color of MTN? Please, what's the corporate color of MTN? What's the corporate color of MTN now? It's yellow. Good. Let's say you purchased this building and it was already painted, but then the color of the paint was green. Do you have to paint it again? The color of the paint was green, or when you purchased it, it was already painted, but then the color of the, the paint for the building was green. Do you have to repaint? Yes, you have to repaint to get the building to the what? To get the building to the condition that's necessary, okay, for it to be capable of operating, right? So if the building is not yellow, there's no way you can use it as an MTN office, right? So if they had to repaint the building in the company's corporate color, then we have to capitalize it. But if they had to paint it in maybe the CEO's favorite color, I don't think we have to capitalize it, right? Maybe just favorite, that's my favorite color. No, you don't have to capitalize. But if it's the corporate color, company's corporate color, then you have to capitalize it because you will need it before it will be capable of what? Operating the manner intended by what? Management. Is this explanation okay for you? Is this okay? Friends. So another one, the Mercedes, the limousine. So there is another thing here for us all. So there are other items here for us to determine the cost of what? The vehicle. So Mr. Reader Morrison, can you read them out? Don't read the figures, just read the items. Somebody is saying, so what is the answer? So you see, there is favorite and there is corporate. So in exams, if it happens to be the corporate color, then you capitalize the 300. But if it's not the corporate color, then you wouldn't capitalize. So what's the difference between painting and maintenance? This, when you purchase the building, you are painting it for the first time in the company's color. So with that one, you have to capitalize it. Painting it for the first time, you have to capitalize it. For the first time, you have to capitalize it. Besides, you have to paint it in the yellow and MTN's color before you could even use it as an MTN office, right? Or Telecel office, you have to paint it in what? Red. Otherwise, you couldn't use it. So if you don't paint it, it wouldn't be in a condition that you'll be able to use. So always that guidance on directly attributable cost, you should always apply it. Ask yourself, so would we need this paint before we could use the item of PPE? If that's the case, then you have to capitalize it. Ebenezer Cheneboa Kodia, are you okay? Eben. And then Kwesi Weston, are you okay? Eben and Kwesi, are you fine? Friends, are you fine? Good. Now, Morrison, can you read them out for us? Mr. Morrison.
Yes, madam. Mercedes is, madam.
Mm-hmm.
Mercedes is series estate cars. Number plates for cars. Delivery charge for cars. Road license fee for cars. Driver's wages for first year of operation. Blank taxi receipts printed with NKM Limited's business name and number.
Good. So which of these items should we capitalize for the cost of the car? Which of them should we capitalize for the cost of the car? To calculate it and tell me the cost of the car. That's the cost of the car. Calculate it and give me your answer. Then after that, we'll do it together. I'm saying 116870. Two people are giving me 11680. What about you? What did you get? 1160. 1160. 116870. 116870. Y'all getting one figure. I hope it's correct. I'm not seeing any different figures, so let's do it together. We are doing it together. So Mercedes E-Series estate cars, the purchase price of the car, should it be part? I've seen the difference answer 11840. Okay, let's do it again. So the first one, should it be parts? Mercedes E-Series estate cars, 11,600. Should it be part? Yes, no, yes, no, yes, no, yes, no, yes, no, yes, no. Yes, have it. It should be part. Cool. The number plate for the cars. So when you are licensing your car, you need number plates. The cost of the number plate, should it be capitalized? You need it before you can use the item of PPE. Would you need a number plate before you can use the item of PPE? Before you can use the car, would you need a number plate before you can use it? So should I capitalize it? Yes, no, yes, no, yes, no. Should I capitalize the number plate? Should I capitalize the number plate? Will I need the number plate before I can use the car? Yes. So
Yes.
What about the delivery charge for the car? The delivery charge. The delivery charge.
Yes.
What about road license fee for the car? Those of you who drive, you realize that every year you pay road license fee. Should I capitalize it? The road license fee. Every year you have to renew it. Road license fee for the car. Should I capitalize it?
Yes,
Should I
madam.
capitalize road license fee?
Please.
No. Those of you who drive, you know that this is a revenue expenditure. Road license fee is a revenue expenditure. Every other year you have to pay that money, otherwise you can't take the car to the road. So road license fee is a revenue expenditure. We don't capitalize it. What about driver's wages for the first year of operation? Driver's wages for the first year of operation. Remember, we are looking for the cost of the car. The cost of the car. The road license fee is a revenue expenditure. We don't capitalize it. The driver's wages for the first year of operation. The person who will be driving the car. His wages for the first year of operation. Should it be part of the cost of the car? Should it be part of the cost of the car? The driver's salary or his wage? No. What about a blank taxi receipt printed with NKN business name and number? It's blank. We don't really know what it is. Should I capitalize it? So it's a no. So this means that we only capitalize the first 1, 2, 3, the first 3. The rest are not parts, so you only need the first 3. So add the first 3 for me. What do you get? What do you get? 11,6,3,9,0. Did you get that? 11,6,3,9,0. Madam, please, the road license. You have a question? But see, the road license fee, by the time you even go for this, now you are done with the car, you are done with the cost of the car, the value of the car before you even get to this point. With the road license fee, until you go for that one, you can't drive the car on the road. It's a revenue expenditure. Every other year you incur that cost, so we don't capitalize it. By the time you even need a value of the vehicle before you can go in for that one, before you can go for the road license stuff. You need to determine the value of the vehicle before you even go to that stage. So for the road license fee, it's a recurring expenditure. It's a revenue expenditure. They say, are you okay? All right. So we are done with this. Enough of the course. We've done a lot of example on cost. So I think the solution is here when you get a slice. So let's go to subsequent expenditure. So initially, an item of PPE should be measured as what? Cost. So subsequently, when you incur expenditure, what should you do? Should you capitalize it or not? So over here too, the standard has given you guideline on subsequent expenditure you incur as far as the item of PPE is concerned. The standard has given you a guideline. So expenditure that is incurred in replacing or renewing a component must be recognized in the carrying amount of the item of PPE. Do you remember the meaning of carrying amounts? The cost of the assets minus accumulated depreciation minus accumulated impairment losses. So anytime you incur expenditure in replacing or renewing a major component, you have to recognize it in the carrying amount of the item of PPE. Such subsequent expenditure should enhance the benefits of the asset. So those subsequent expenditure that you should capitalize, those subsequent expenditure that you should add to the carrying amount, those subsequent expenditure should enhance the benefits of the asset. Example, that is, increases the revenue capable of being generated from the asset. So you just don't capitalize any subsequent expenditure. It should, besides that, it will enhance the benefits of the assets. So the standard has given you guideline. That's giving you guideline on what the subsequent expenditure. So the carrying amount of the replaced, renewed component should also be recognized. Let's say you are replacing the engine of a vehicle, right? The engine is a major component of the vehicle, and definitely by replacing the engine, it will enhance the benefits of the asset. So what the standard is saying is that after replacing it, then add the value of the new engine to the carrying amount of what? The vehicle. And also derecognize the value of the old engine. So you have to derecognize the carrying amount of the replaced engine, the old one, derecognize it. Derecognition simply means subtract the carrying value of that portion that you are replacing. Subtract the carrying value from what? The carrying value of the entire vehicle. Is that okay? So let's say the old engine, the carrying value for the old engine is, let's say, 10,000. So subtract that 10,000 from the whole what? Value of the car. Let's say the value of the car is, the carrying value of the entire car is 90,000. And the portion of the engine that you are replacing is what? 10,000. So subtract that 10,000 from the 90,000 before you add the value of the new engine to the carrying value. Is that one clear? Please, is it clear?
Yes, madam.
Mm-hmm.
Yes, madam.
We'll definitely solve a question with this. You don't have to recognize day-to-day servicing cost or recurring cost. Don't recognize day-to-day servicing cost. Please, is replacing an engine generically different from maintenance? Yes, engine is a major part of the vehicle and it's very expensive. So replacing it, even when you learn revenue and capital expenditure, it will even tell you that it's a capital expenditure. So it should always be capitalized. And definitely when you place the engine, it will enhance the use of, even battery, when you place battery, it will enhance the use of the asset. You can capitalize that one. But in recent time, battery is very expensive, and when you replace it, it will enhance the value of the asset. How much more engine? So yes, it should be capitalized. It's not an engine, you don't do it on a regular basis. Once, sometimes for certain cars, maybe once in the lifetime of the car, you replace the engine. For some, you don't even replace it at all. So in the battery that you can replace it maybe every 2-3 years. Is that okay? So Kitty says I should go over. I don't know which of them I'm supposed to go over. So derecognition. After replacing a component of the asset, what we are saying is that the old component that is being replaced, okay, subtract the carrying value of that old component from the value of the assets in the books, and then add the value of the new components you are purchasing, add it to the carrying value. That's what we are saying. Are you okay now? The person who asked me to explain, I should go over. Kindly go over. Kissy, are you all fine now? Kissy, are you fine? Good. Somebody is also saying part of service cost of the mechanic who replaces. No, 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 no. You don't capitalize it. And again, you don't capitalize maintenance costs, those things, you don't capitalize them. They are all recurring expenditure. So for some people, their vehicle every 3 months, they have to go for servicing, you place, change the oil here and there, those things. You don't, it's a recurring cost. You don't capitalize it. Depending on your usage, some people too, they change their oil every 4 months or 6 months, depending on the usage. But for some, even the commercial vehicle, every month they change the oil, every month, hot oil. So every month you be capitalizing. You don't do it like that. Is that okay? Can I move on? Subsequent expenditure, how to add the cost of that, the new component to the carrying amount, and then derecognition. I hope it's clear. Can I move on, friends? Can I move on? Good. Now, exchange of assets. Items are measured at fair value. If you are exchanging assets, then the value of the item should be at fair value, unless the exchange transaction lacks commercial substance, or the fair value of neither of the item being exchanged can be measured with reliability. If you are exchanging assets, then the value should be what fair value. If you are exchanging asset, maybe I have a car, you also have a car, you want to exchange at what values? Use the fair value of the asset. Madam, do you capitalize fuel? But no, we don't capitalize fuel. It's a recurring expenditure. Good. If the acquired item is not measured at fair value, its cost is measured at the carrying amount of the asset being given up. If the fair value cannot be determined, then the value for the item being exchanged should be at what the carrying value. Okay, if you can't determine the fair value, then you should use the carrying value. So that's about exchanging assets. Okay, so everything we've done so far is what? Initial cost, blah, blah, blah. Now, measurement subsequent to initial recognition. I told you that according to IAS 16, an item of PPE should initially be measured at cost. So for the first year of purchase of the item of PPE, you have to measure it at cost. What about subsequent years? So in the second year, how should you measure PPE? In the third year, how should you measure PPE? In the fourth year, how should you measure PPE? Measurement subsequent to initial recognition. According to IAS 16, we have two possible treatments. We have the cost model and then the revaluation model. Two possible treatments for measurement subsequent to initial recognition. Two treatments. We have the cost model and then the revaluation model. So every company should have one of the models. So that will be your accounting policy. You see, each companies have their accounting policies and all that. So they have the accounting policy on non-current asset. They have the accounting policy on inventory. They have the accounting policy on revenue. They have the accounting policy on almost every item on the financial statement. According to IAS 16, you can have two. There are two policies. You can have one of them. Are you using the cost model or the revaluation model? Cost model or revaluation model? So if you are using the cost model, then you have to carry the asset at its cost less depreciation and any accumulated impairment losses. If you are using the cost model, subsequently in future, in the second, third, fourth, fifth year, how should you recognize the asset in the books? How should you treat it in the books? How should you measure it in the books? If you're using the cost model, then you have to carry the asset at its cost less accumulated depreciation and any accumulated impairment losses. So that's what the cost model is saying. If you're also going for the revaluation model, then the standard is saying subsequent years, you have to carry the asset at a revalued amount. That's being its fair value at the date of the revaluation. If there are any accumulated depreciation and impairment losses, you have to subtract. But if you are using the revaluation model, every year you have to revalue the assets and use the new revalued amount. That's what we call the fair value, the new revalued amount. It's called the fair value. The fair value. Every year revalue the item of PPE to get the fair value. If there is any accumulated impairment loss and then impairment depreciation subtracted from the new value. So that's what the standard is saying. Either cost model or evaluation model. So depending on what you settle on, this is what you do for cost, this is what you do for evaluation. Is that one clear? But initially you measure it at what? Cost. Whether you are using the evaluation or the cost model, the initial recognition or the initial measurement should be at what cost. And you and I know what we mean by cost, what it entails. The purchase cost, dismantling or the removal, and then what? Directly attributable cost. But in subsequent years, how do you value the item of PPE? Either the cost model or evaluation model. If you are using the cost model, carry it at what? Cost less accumulated depreciation and any accumulated impairment loss. But if you are using it at what? If you are using the revaluation model, then at the end of every year, revalue the item of PPE to get what the fair value and use that one. Is it clear? Is it clear? Is it clear? Is it clear? Can I move on? Friends, is it clear? My friend, is it clear? Can I move on? Are you okay up to this point? So the person asking Ebenezer, Madam, if the company uses reducing balance method, can it be possible for them to use revaluation method? It's a policy. So if as an organization you want to choose reducing balance as your policy, that's fine. And if you want to use fair value as your policy, that's fine. That's why it has given you the opportunity to subtract any what? Accumulated depreciation and then accumulated what? Impairment losses. But take note, if you are using a reducing balance, in calculating the depreciation, you always need a carrying amount. But here is the case, every other year you are going to revalue the item to get a fair value. So how then will you be applying the reducing balance? Because you are always going to use a different figure. So with this one, this depreciation thing and all that, you wouldn't even be seeing them if you revalue every other year. If you revalue maybe 2 years, 3 years, that's where the depreciation even comes in. Otherwise, if you are revaluing it every other year, there wouldn't be any room for even the calculation of depreciation. Because at the end of the year, you are revaluing the assets. At the end of the year, you are revaluing the assets. Is that okay? So the depreciation only comes in maybe you evaluate every 2 years or 3 years. So within the 2 or 3 years, the accumulated depreciation, that's where it comes in. Otherwise, if you are doing it every year, why not? Somebody want me to go over the models. See the way I've explained it. I think I went over for more than 10 times. Did you go off for something? Tahiru, did you go off for something? If you went off, then maybe you can rely on the video later. You were right here. So what I'm saying is that according to IAS 16, the initial measurement of any item of PPE should be at what cost? But when you go to the second year, third year, or so when you go to subsequent years, how should you measure the cost? How should you carry the item in the books? And the standard is saying that there are two models. You have the cost model and then the revaluation model. If you are using the cost model in subsequent years, you have to carry the item at its carrying what amount? By carrying amount, I mean cost minus accumulated depreciation minus accumulated impairment losses. So in subsequent years, carry the item of PPE at what? The carrying amount, cost minus accumulated depreciation minus accumulated impairment losses, if you are using the cost model. But if you are using the revaluation model, you have to carry the item of PPE at its fair value. It means that every other year you have to revalue the assets, determine the fair value, and that should be the value to use in the books. Is that okay? And whether to use the cost model or the revaluation model is a choice. It's a choice. It's a decision that the company has to make as far as the accounting policy is concerned. So they have to determine between cost and then the revaluation. They have to stick to it. You don't have to be changing your accounting policy every other year. No, you have to stick to one policy. That's why if you have to change your policy, then there are a lot of things that goes into it, and that will be our third topic also. IAS 8, changes in accounting policy, accounting estimates and errors, and its effect on the financial statement. So if you change accounting policy, you have to use the retrospective application. Okay, so you don't change your accounting policies. You only change it when it becomes necessary. And if you are changing it, you have to indicate the reason for the change in the notes to the accounts, and also the impact of the change has to be what's calculated, computed, and then it has to be affected in the financial statement. So that's it. So the person who wanted me to go over, Tahiru, are you fine now? Are you fine? The rest of you, are you fine with the models? Tahiru, good. Please let me finish PPE before we close for today, for your own good. It will take us more than 2 hours, but I think you should stay through for me to finish PPE for your own good. That's what I can tell you. So then the next time I meet you, we can move on to a different topic. Good. So IAS 16 makes it clear that revaluation model is available only if the fair value of the item can be measured with reliability. You only go in for fair value when every other year the fair value can be determined Because if you are using the fair value, it's a requirement on you to always determine what the fair value at every other year. So if the fair value cannot really be determined, then why don't you stick to your cost model? So that's a caution for accountants. You have to maintain consistency of the policy for each class of assets. Maintain consistency. All right. Now, so those who will be using the fair value, I've told you that every other year you have to be revaluing the assets. You have to do revaluation of assets. So let's learn some principles on revaluation. Let's learn some principles on revaluation. I know you learned revaluation in partnership last semester, but let's refresh our minds. So you have to review periodically and keep revaluations up to date. The frequency of revaluation will depend on the volatility of the fair value. If it's so volatile, then maybe in the course of the year, you can even revalue it about twice or maybe 3 times, or at least once in a year if it's volatile. If an item is revalued, the entire class of the assets to which it belongs will also be revalued. You have to depreciate the revalued asset less residual value over its remaining useful life. You actually go through questions with some of these things, so it will become more meaningful to you. You'll be solving questions very soon. Anytime there is revaluation, it will resolve at revaluation surplus or revaluation reserve. Revaluation surplus or revaluation reserve. Anytime there is a revaluation. But there can also be revaluation loss. The revalued amount or the fair value is higher than the carrying amount, will lead to revaluation surplus. But if the revalued amount or the fair value is lower than the carrying amount, then it will lead to revaluation loss. I hope you know this from last semester from partnership. So when there is revaluation surplus or revaluation reserve, what do you do to it? You have to credit it to other comprehensive income. Other comprehensive income. And it should be accumulated in equity unless it represents a reversal of revaluation loss of the same asset previously recognized as an expense. Again, with these two, I'm going to take a question for it to be meaningful to you. We'll go through a question very soon. But if there is a revaluation surplus, where do you take it to? Other comprehensive income. And with I told you I will be looking at final account of a company. So with the final account of the company, the income statement, there is a portion called the other comprehensive income. We add it to the profit for the year, okay, to get total comprehensive income. If you had gone through IAS 1, the format, this would have been meaningful to you, but you didn't go through IAS 1 from what you tell me. So we'll look at that later. But what you should know is that there is other comprehensive income on the statement of comprehensive income or on the income statement of a company. Whenever there is revaluation surplus or revaluation reserve, you take it there. In the income statement, you take it to other comprehensive income. Then when you go to the balance sheet or the statement of financial position 2, you also take it to reserves, okay, or equity. So you take it there to equity and reserves. So it will be part of the reserves. So we call it revaluation reserve. So that's how you treat it. What if there is revaluation loss? There is revaluation loss. When you do the revaluation, the carrying amount is more than the fair value. Revaluation loss is when the carrying amount is more than the fair value. And the revaluation surplus is when the fair value is more than the carrying amount. Good. So if there is a revaluation loss, then you have to recognize it as an expense in the income statement. Just add it to expenses. So you see in the income statement, you have income or revenue, less cost of sales, then you get your gross profit, you add additional income, less expenses. That expenses where you have your depreciation, you have various expenses. Then revaluation loss should be part of that expenses. Revaluation loss should be part of that expenses. Is that okay? But then if it exceeds any amount previously credited to the revaluation surplus, then you have to reverse it. Again, this one will solve a question for it to be meaningful to you. But the primary thing you should know is that revaluation surplus or revaluation surplus should go to other comprehensive income, and revaluation loss should be treated as what? Expense. That's what you should pick from this slide. So when a revalued asset is disposed of, any revaluation surplus may be transferred directly to retained earnings or may be left in equity. Please, can an asset be revalued more than once? Of course. If it becomes necessary, why not? You have to revalue it. You don't have any option. So if you are using the revaluation model and then the value changes, you have to revalue it. You have already revalued it and then you realize that the value has changed. Then this means that it's highly volatile. Then you have to revalue it again. So yes. The person Ebenezer, yes. So there's a question here. Morrison, can you read for us? Mr. Morrison. Mr. Morrison.
Madam,
Read for us. There's a question
Jefferson Limited. Okay. Jefferson Limited has an item of land carried in its books at Ghana cedis 13,000. 2 years ago, a slump in the land values led the company to reduce the carrying value from Ghana cedis 15,000. This was taken as an expense in profit or loss. There has been a surge in land prices in the current year. However, and the land is now worth 20,000 cedis. Account for revaluation in the current year.
We'll start work. Please start work. You have 3 minutes. So try a hand on it. What did you get? What's the revaluation surplus or loss? What's the current value? What's the current value of the assets? The current value of the asset. Jefferson Limited has an item of land carried in 8 books at what? 13,000. So currently the value of the land is 13,000. That's the carrying amount. So 2 years ago, a slump in land value led the company to reduce the carrying value from 15,000. So 2 years ago, it was 15,000. So 2 years ago, what was the revaluation surplus? 2 years ago, there was revaluation. Okay, the value was 15 and it changed to 13. So 2 years ago, what was the revaluation surplus or loss? Surplus or loss of how much? 2 years ago, what was the revaluation surplus or loss? 2 years ago, 2 years ago, 2 years ago, 2 years ago. 2 years ago, the item was 15,000 and it was revalued to 13,000. So 2 years ago, what was the surplus or loss? Surplus or loss. Obian can be a surplus, a busy loss. Obian can be. Don't just type 2,000. Is it surplus or loss? Loss for any yard also. Surplus for more. Is it surplus or loss? Again, let me tell you when it's surplus or loss. So listen to me. Anytime you are revaluing an asset, you compare fair value to what the carrying amount, what's in the books. What's in the books is what the carrying amount. So you compare fair value, okay, to the carrying amount. So anytime the fair value is more than the carrying amount, you have what? Surplus. But anytime the carrying amount is more than the fair value, you have loss. So in this case, what is happening? 2 years ago, a slump in land value led the company to reduce the carrying value from 15 to 13. So it means that 2 years ago, the carrying value was 15 and then the fair value was 13. So there was a loss of 2,000. There was a loss of 2,000 2 years ago. So how was the loss treated? How do you treat revaluation loss? How do you treat revaluation loss? How do you treat revaluation loss? You treat it as an expense in the income statement. Esther say, Madam, the explanation again. Explanation for which of them, Esther? Esther, I want to hear from you. Esther, which of them do you want me to explain?
Madam, please, the carrying cost and the
Carrying, okay, carrying value and then, okay. So I'm saying that whenever there is
please, the
revaluation, it's
carrying
okay.
cost and the valued amount.
Okay, so I don't know. Let me just go back to the basics. Let me explain what carrying amount is, and then let me also explain what's fair value. Whenever we say carrying amount, is the cost of the item of PPE minus accumulated depreciation minus accumulated impairment loss. That's carrying amount. Cost minus accumulated depreciation minus accumulated impairment loss. So usually carrying amount is the value of the asset in the books. Usually carrying amount is the value of the asset in the books. Cost minus accumulated depreciation minus accumulated impairment losses. We also have the fair value of the asset. That's the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants, okay, at the measurement date. So if you want to buy the assets now, when you go to the market, what's the value? That's the fair value. The fair value of the asset. Is that okay? The price that market participants will be what? Willing to accept. Okay, that's the fair value. So anytime you are revaluing your assets, you compare the fair value to the carrying amount. The carrying amount is the value in the books. Compare the fair value to the carrying amount. If the fair value is more than the carrying amount, the revaluation is leading to what? A revaluation surplus. Esther, I'm talking to you. And if the carrying amount is more than the fair value, then the revaluation is leading to what? Loss. So now let's come to the question. Esther, coming to the question, we are being told that 2 years ago, the value of the land was 15,000 and there was a slump in land prices, so it reduced to 13,000. So Esther, 2 years ago, what happened to the value of the land as a result of the revaluation? Did it reduce or it increased? Was there revaluation surplus or loss? Esther, can you unmute and then talk to me? Don't type. So 2 years ago, was there revaluation surplus or loss? And how much was it? Esther, are you missing? Mommy Esther, are you there? All right, let's move on. Maybe she's offline. Oh, she's been disconnected. Maybe that's why she requested for the explanation again. Maybe her network is not stable. So let's just move on. So we all agree that 2 years ago there was a revaluation loss of what 2,000. And how would that be treated? We also agree that it should be treated as an expense in the income statement. Good. So what is happening now? What is happening now? There has recently been a surge in land prices, right? So the land is now worth 20,000. So now the fair value of the land is 20,000. So is this leading to valuation loss or surplus? Remember that currently the value is 13,000. And now the fair value is what? 20,000. So this 13 is now the carrying value and then 20,000 is what? The fair value. So is this leading to a revaluation surplus or loss of how much? So you indicate surplus this or loss that. So is this leading to a revaluation surplus or loss of how much? Let me hear from you in the chat. Revaluation surplus or loss of how much? I see surplus of 7,000, surplus of 5,000, surplus of 7,000, 5,000. 5,000 for where the same. You compare the carrying value to the fair value. You compare carrying value to the fair value. The 5,000 for no more yet. Compare the carrying value to the fair value. So it's 7,000. Currently, the carrying value is what? 13 and the fair value is 20. So the difference is 7,000. So currently we are having a surplus of 7,000. A surplus of 7. Hey, Janet, now going to loss way.
Ah.
Sister Jane, where is the loss coming from? Miss Janet Champon. Oh, how did you get this loss of 7,000? Jane, we need you to explain. Miami Jane, oh, explain it to us. How did you get a loss of 7,000? I've told you that I want you all to get A's. In pay B cry. And Jane, the old church lady, and her B cry bedding. Sister Jane, how did you get a loss of 7,000? Miami Jane. Okay, Janet is saying it's a surplus. Okay, Jane, that's it. Jane, you are forgiven it. Otherwise, in care report too. Madam Parry. Okay. So Jane, you are forgiven. Jane, I hope you understand. Jane, do you understand? Hello, Jane. Okay. Madam, does it mean that fair value for the previous year becomes carrying value for the current year? So carrying value simply means that the book in the, the value in the books, the value of the item in the book. So if previous year you revalued and yes, and now that's what you are carrying in the books. Carrying value becomes the value in the books. Fair value only comes in after doing the revaluation. Get the actual market value. If you get the actual market value and you record it, then as soon as you record and you go to subsequent years, yes, it has become the carrying what value, the carrying value, the book value, the net book value. Pauline, are you fine now? Sister Lodina, are you fine? Okay, some people
Yes,
are really
ma'am.
contributing also. Please, at the end of the semester, I have to reward them. So all those who are contributing, who are typing here, asking questions, just say they have to be rewarded. Plus the class reader. So more I'm typing, just be observers. Why? They'll be say, okay, yes, madam. Okay. All right. So we move on. You say the yes, and don't better type is we go be a pen mask at there. All right. Well, at least I remember Joy, some of the name. Is it Lois or Tabusa questions spam? And some people really contribute and all that. And I'll save the chat too, so I can go through later. And yet, yes, for no. Yes, Kwadomunka. Those who give me responses, good responses with explanations here and there. Kwesi too is there. Yeah, Kwesi, I see you. And Ebenezer, that guy. I mean, and I'm a couple of names. I mean, Bright, I feel nice. Okay, let's come back to IAS. Dave cried in me, who cried that? Yes, Ebenezer actually, why? Yes, I see you. Ebenezer, Lois, and a couple of them. The way we've chastised The lady, what's the name? A champon. Is it Esther? Tono dear say the Yamanaka crown. Come for the enemy who. Anyway, enough. Let me just close this chat and concentrate. So now the revaluation surplus is what? 7,000. How do we treat this revaluation surplus? I told you that you take revaluation surplus to what? Other comprehensive income. Other comprehensive income. Other comprehensive income. Unless there is a reversal that you have to do, you take revaluation surplus to other comprehensive income. Unless there is a reversal. The reversal come in when previously we revalued the same asset and maybe got what? A loss in this case. So when you previously revalued the same asset and you got a loss, and now you are revaluing and you are getting what? A surplus, then you have to go back and reverse that previous loss. If there is no previous, revaluation that you have to, revaluation loss or something that you have to reverse, then you take the entire 7,000 to other comprehensive income. But you and I know that previously there was a revaluation loss of what? 2,000, which was debited to the income statement as part of the expenses. So we have to reverse this 2,000. How do you reverse it? By going back to the income statement, and now instead of debiting it, you go and credit it with the same 2,000 to cancel it, sort of, to write it off, sort of, right? So now you credit the income statement with 2,000 out of the 7,000, and you'll be left with what? 5,000. So you take 5,000 to other comprehensive income instead of the entire 7,000. Because previously you revalued the same asset and you recorded a loss of 2,000, which was debited to the income statement, or which was added to the expenses. Now you are getting a surplus of 7,000 on the same asset. So you go back and revert that previous loss you recorded. You reverse by what? Subtracting it from the expense before you added to expense. So now you go and subtract it to expense by what? Crediting the income statement. So when you do that, you'll be left with 5,000. So that 5,000 will go to other comprehensive income. And then it will also go to revaluation reserve in the balance sheet or statement of financial position. Is the explanation okay for you, friends? Is the explanation okay for you, friends? Is the explanation okay? So 5,000 will go to other comprehensive income. 2,000 will go to income statement, okay, to cancel off the previous 2,000. And then that 5,000 will go back to other to revaluation reserve in the balance sheet. Is it clear? Is it clear, friends? Let me know if you understand it. In which account will the offset take place? You open revaluation account. You open revaluation account. You open revaluation account. Revaluation account. Revaluation account. So I hope you know how to go about that. You know how to go about it. So you open revaluation account. So this is my handwriting. My handwriting is bad, oh. So this one is real. It's one of my weaknesses. I don't have nice handwriting. So this is how the revaluation account will be. Whenever there is revaluation surplus, you credit the revaluation account and you debit the asset account. So if there is revaluation loss, you rather credit the asset account and then you debit the revaluation account. So let's take the first revaluation that was done where we got revaluation loss of what, 2,000. So that one, it was a loss. So we credit the asset account and debit revaluation account. So we'll come here, asset, right? And it was what, 2,000. Okay. Then the asset account will be credited. And this year too, when we revalued, we got what, 7,000, and it's a profit. So we'll credit it and then debit the asset. So we'll come here, assets. So asset of what, 7,000. A and go home. So what do we do? I have to clean, right? Where is my reader? Or better so, let me just, so that year that we did the revaluation, let me balance of the revaluation account. So we take back my pen. So with the year that we did this, we'll go to P&L, right? We write off by going to P&L. 2,000. So that this 2,000 will go to the expense, right? We go to the expense. Then you close it. Then this year you have to reinstate the 2,000 by what? Crediting the P&L account. Okay, you credit the P&L and then you debit the revaluation. So we'll come here, P&L, 2,000. Debit revaluation and credit P&L. And this year we've revalued and we are getting how much? 7,000, right? So assets, 7,000. Okay. So balancing of the account, you'll be left with a balance CD of what? 5,000. So that balance CD will take it to what? Take that balance CD to the balance sheet as what, the reserve. So 5,000 as the reserve. That then they will get our 7,000. Then our 7,000. You did this in partnership, right? So how to do this revaluation? I know you did this in partnership. So in partnership, did you open the revaluation accounts like this? Did you open it like this?
Yes,
So it
yes,
means
but
you
we
are
didn't
familiar.
close it like this.
Say again.
We did it like this. We opened it like this, but we didn't close it like the way we are doing it.
So you can close it like that. So where does it go to? Debit credit. So it's basically about debit and credit. So that's it. So at the end of the day, you have 5,000 standing on the revaluation account. That 5,000 will go to the reserves, right? Okay, so the person who asked that question, how do you do the offset? Are you okay now? The person who asked how you do the offset, please. Are you fine? Okay. Let me go back to my next question. So this is the question we just saw. Oh, that's the solution. Oh, this is a different question. Okay, this is the question that we were solving. Can you repeat the balance CD of reserve? When you are balancing up account, I think we call it balance CD. So for any account, the balance CD become BD and that would show you where it will go, right? So you don't call it reserve, we just maintain the balance CD or balance, but then we know that it will go to the balance sheet and it will go there under what? The revaluation reserve. So for double entry principles, it should be what? Balance CD. And it becomes BD in the following period and it goes to a reserve. Ebenezer Chunibwa, you said you were the 2 CD. Why? Ka u maintain a watch 2 cedi na ka unya max for contribution. You see, change of name is better. All right. So please, are you okay with this very example? Can I move on to the next one? Please, can I move on? I have several examples for you. Move on. So there is another one here. So when you get a slice, you have the solution here. I think there was another question. This is what I'm looking for. So, Morrison, can you read for us? I was looking for this.
Okay, madam. JC Limited has an item of land carried in its book at 20,000. 2 years ago, a surge in land values led the company to increase the current value from 15,000. There has been a slump in land prices in the current year, however, and the land is now worth 13,000. Account
Okay.
for revaluation in the current year.
All right. Thanks, Morrison. So, here's an item of PPE, item of land carried in its books as what? 20,000. So now what's the carrying value of the asset? 20,000. The asset is now 20,000. So 20,000 is the carrying value or carrying amount. 2 years ago, a surge in land prices led the company to increase the carrying value from 15. So 2 years ago, it was 15,000 and they revalued it to 20. So 2 years ago, what happened? Was there a profit or a loss on revaluation? 2 years ago, was there a profit or loss on revaluation? Surplus of what? Hey, loss no kunya no one. His sister loss. Marcus, who kunya loss no? Eh? Bra Marcus. Brother loss. Oh, Marcus, where did you get the loss? You just don't type, oh, Marcus. Counting IAN, you just don't type anything. Or was it Portia who said you lost? Just don't type anything, oh. Just don't type anything. I said, you analyze one or two, just don't just type anything. No, 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 no. You have to analyze it first. I say Portia, and Marcus, Sister Portia. So Sister Portia, Samato. Okay. So it's a surplus. It's a surplus. 2 years ago, it was 15,000 and they revalued it to what? 20,000. So it's a surplus of what? 5,000. Portia, are you okay? Do you now see the surplus of 5,000? Posh, do you now see the surplus of 5,000? Portia, come and report yourself here. Hello, Posh. Good. You now see the surplus of 5,000. So 2 years ago, how was that surplus treated? The surplus, how was it treated 2 years ago? How was it treated? Portia, can you answer this question? 2 years ago, that surplus of 5,000, how was it treated? How was it treated, please? They say, Boache, who is spokesperson for Portia? Hey, Boache, who you are Bema? Portia, on kasa. Ne Boache kasa mani. What is Portia saying, Boache? So how was that surplus of 5,000 treated 2 years ago? Mr. Wache, Porsche spokesperson, can you find out from her and tell us? Credited to other comprehensive income, correct. Later on, watching Porsche may investigate him, but for now, let's concentrate on IAS 60. Okay. So it was credited to other comprehensive income, or it was added to other comprehensive income, right? Good. So now what is happening? There has been a slump in land prices in the current year, however, and the land is now worth 13,000. So the land is now worth 13,000. So in recent time, what is the revaluation surplus or loss? Remember, carrying amount is what? 20,000. The carrying amount is 20,000. And now the value is what? 13,000. Now the value of the land is 13,000. So now what is happening? What is happening now? A loss of 7,000. Yes. Wow, Bettina Samato. I told you not to write the 7,000. Let us know if it's a loss or what. Surplus. So loss of 7,000. The more mutual value no more max no more can be free max no more come. So a loss of 7,000. Good. So now the loss of 7,000, what do we do to the loss of 7,000? Should we take it straight away to expense, or there has to be a reversal? So should we reverse, or what do we do? Should I take the loss straight away to income statement as an expense, or I should reverse it? Do I have to reverse it, or I should take it straight away to income statement as an expense? I have to reverse it because previously there was a revaluation on this same asset and we recorded a surplus of 5,000. So that surplus is there. So we have to reverse. So after reversing, reversing here simply means that we go and knock off that 5,000 from the current loss of 7, right? So after knocking off the surplus of 5,000 from the loss of 7, now what do we get? We'll still be left with a loss of how much? 2,000. So that loss of 2,000 will now go to the what? Income statement as an expense, And then the revaluation reserve of 5,000 in the balance sheet will go off. It will go off. It will go off. I hope it's clear now. Is it clear? Is it clear, friends? So here is it. So the land account will be credited with the 7,000. Revaluation account will be debited with what? 7,000 to knock off the 5,000 surplus already in existence, and 2,000 cedis will be carried as P&L account as an expense. Capital reserve will be debited with the 5,000 to cancel off the closing balance of 5,000 on the revaluation reserve. So when you get the slides, I have all of these for you. All the solution is in there for you. Okay, good. So additional factors. Let's look at the situation where there is what? Depreciation. Note that depreciation starts when the asset is ready for its intended use, not when the asset actually starts use. So assets can be ready for its intended use, and then the company will not start using the assets. It can be there for 2-3 years. Now you see the until case. You have to calculate depreciation every year. So far as it's ready for its intended use, you have to start calculating depreciation. That's what the standard is saying. The depreciation should start when the asset is ready for its intended use, not when we start using it. So take note of this. In future, you can see this in a question. The asset will be ready for its intended use, but then we'll start using it later. So when will we start calculating the depreciation? So take note of this. This is coming directly from the standard IAS 16. So take note. Highlight it when you get a slide. Good. Any change in estimate is applied prospectively by applying the new estimate to the current value of PPE at the date of the change. I told you that there can be a change in the accounting policy. There can equally be change in the accounting estimate. By estimate, we mean the useful life or the rate of depreciation. That's the accounting estimate. It can also change in as much as the accounting policy can change, the estimate can equally change. Is that fine? So whenever you change the accounting policy, there is a procedure for you to follow. Equally, when you change the estimate too, there is a procedure for you to follow. Whenever you change the estimate, you have to use the prospective application. Prospective simply means that you use the new estimate in the year of what? The change. You use the new estimate, or you apply the new estimate in the year of the change. You won't go to previous years to make any changes here and there. You only started from the year that you changed it. That's why we say prospective application. Prospective application. But let's say the rate used to be 20% on cost, and now you have changed the rate to 15% on cost. Start applying the new rate in the year that it changes. Simple as that. That's prospective application. The accounting, the useful life used to be 20 years. Now you have changed it to 10 years. Start applying the new useful year in the year that you change. Is that okay? Is this one difficult to understand? Friend, is this difficult to understand? Is it difficult to grasp? Prospective application for change in accounting estimates. Friends, are you there? Can you hear me? Is it clear? Can I move on? I'm not hearing from you. Does that mean I can move on? Anyway, so I've given you a formula for revaluation surplus. It's equal to revalued amount. So that's fair value minus carrying amount. Whenever there is revaluation surplus, then it means your revalued amount is more than your carrying amount. And if there is revaluation loss, then it means the fair value or revalued amount is less than the carrying amount. Don't forget those. Because when we say no, the way they good. Me say with the PPE question I'm set to be why? Because my sure say you're gonna get a lot of questions on PPE. I'll mark it for you. If you buy the positive income, is that fine? Okay. So carrying amount again, I'll give you the formula. It's equal to cost minus accumulated depreciation minus accumulated impairment loss. So I have a question here for you, class reader. Can you help me by reading? Class reader, can you read for me? We'll finish very soon. Right? We'll finish very soon. Very soon.
MFA Limited. Okay. MFA Limited bought an asset for 10,000 at the beginning of 2016. It had a useful life for 5 years. On January 1st, 2018, the asset was revalued to 12,000 change into bracket. That's 3 years remaining. A. Accounts for revaluation and treatment for depreciation from 2018 onwards. B. The asset treated.
So the reading wasn't smooth. Is it coming from my end or your end?
Rather my end, the network. I'm going over. MFA Limited bought an asset for 10,000 at the beginning of 2016. It had a useful life of 5 years. On January 1st, 2018, the asset was revalued to 12,000. The expected useful life has remained unchanged. That is 3 years remain. A. Account for the revaluation and treatment for depreciation from 2018 onward. B. The asset was sold on January 1st, 2019 for 9,000.
It's okay. So it's fine. Let's take it one after the other, if you can hear me. So MFR bought the asset for 10,000. So that's the cost of the asset, right? At the beginning of 2016. So anytime you get question on PP, there are certain you look for the cost, look for carrying amount, look for fair value, depreciation rate, or useful life. Those are the things you need, right? to make various calculations or computations. So they purchased the asset for 10,000. So that's the cost of the asset at the beginning of 2016. It had a useful life of 5 years. So what's the depreciation per annum? Cost is 10,000. Useful life is 5 years. So what's the depreciation per annum? What's the depreciation per annum with this information? If you can, depreciation per annum. Let me hear from you in the chat. Depreciation per annum. Let me hear from you in the chat. 2,000, 2,000. So 10,000 divided by 5 years, right? Give you 2,000. So that's the depreciation per annum. That's how you solve PPE question. Oh. That's where you start from. Good. Take it one after the other, okay, bit by bit, and you'll be able to do it. So on January 1, 2018, so as at January 1, 2018, we had used the asset for how many years? As at January 1, 2018, we had used the asset for how many years? As at January 1, 2018, we had used the asset for how many years, please? Hey, 6 years. Hey, my God. You purchased the item in 2016?
Yes.
And as at January 1, see, I'm not why. Hey, we hear beatings. Send me talking, man. Main coherent. 6,000 away. Who gave me that 6,000? How did you get it? 6,000, how did you get it? Okay, so 2 years, right? We had used the item for 2 years. You know why I'm looking for this? To calculate the accumulated depreciation on the assets as at the time of the revaluation. Anytime you get revaluation question, you need is accumulated depreciation so far on the item of PPE being revalued. So as at the revaluation date, we had used the asset for 2 years. So what's the accumulated depreciation for the asset as at the time of the revaluation? What's the accumulated depreciation as at the time of the revaluation? What is the accumulated depreciation? Let me hear from you in the chat. Good. How did you get a 4,000? That's the depreciation per annum of 2,000 times 2 years. The depreciation per 4,001. Hey, the depreciation per annum of what? 2,000 times 2 years. That's the accumulated depreciation. Good. So on 1st January 2018, the asset was revalued. Anytime you are revaluing assets, you have to compare the revalued amount or the fair value to the carrying amount. So what's the carrying amount of the asset as at the time of the revaluation? What's the carrying value of the asset as at the time of the revaluation? Know that carrying value is cost minus accumulated depreciation minus accumulated impairment losses. We don't have any information on impairment losses. We only have accumulated depreciation. So what is the carrying value of the asset as at the time of the revaluation? 6,000 is correct. How did you get a 6,000? The cost of 10,000 minus accumulated depreciation of 4,000 will give you 6,000 as the carrying amount. And how do you determine revaluation surplus? How do you determine revaluation surplus? Revaluation surplus is what? Fair value or the revalued amount minus carrying amount. So what is the revaluation surplus? What is the revaluation surplus? Don't be typing 6,000, 6,000. Let me know if it's revaluation surplus or carrying amount or accumulated depreciation, please. Now my question is, what is the revaluation surplus? What is the revaluation surplus? What is the revaluation surplus? Is the fair value of 12,000 minus the carrying amount of 6,000. So what do you get as the revaluation surplus? A surplus of 6,000. Surplus of 6,000. Good. So this 6,000, how do you treat it? You take it to other comprehensive income and also to what? Reserve, revaluation reserve in the balance sheet. And you take it to other comprehensive income in what? The income statement or statement of comprehensive income. Is that fine? Good. So the expected useful life has remained unchanged. After the revaluation, the expected useful life has remained unchanged. That's 3 years remain. So it means that from when did we do the revaluation? So January 1. So it means that at the end of January 2018, what will be the depreciation? What will be the depreciation at the end of December 2018? What will be the depreciation? What will be the new depreciation after the revaluation? Remember, after the revaluation, the new amount or the new figure for the asset is now what? 12,000. And what about the useful life? We have been told that we have 3 years. So we have to use the 3 years now. 3 years remains. So it will be the 12,000 divided by the 3 years, right? And how much would that be? How much would that be? Don't only be interested in the figures, so you should know how we arrive at the figures. That's the crucial thing, how we arrive at the figures. Because in exams, you get something like this, and I'll be uncount. So the depreciation from 2018 onwards will be what? 12,000 divided by 3, giving us 4,000. So it means that 2018 depreciation will be 4,000, 2019 depreciation will be 4,000, 2020 it will be 4,000, and it will be fully depreciated by then. But when you look at a B, so it means that in 2018 the depreciation will be 4,000. That's all. B, the asset was sold on 1st January 2019 for 9,000. So what will be the profit on disposal? The asset was sold on 1st January 2019 for 9,000. What will be the profit on disposal? Remember, as at 31st December 2018, we calculated the depreciation to be what? 4,000. So as at that point, what will be the carrying amount? As at December 2018, what will be the carrying amount? Let's take it bit by bit. As at December 2018, what will be the carrying amount? 8,000. Good. And we sold it for what? 9,000. So what will be the surplus? The surplus will be 1,000. The surplus will be 1,000. The surplus, so if you were able to get 9,000, then you are correct. The surplus is 1,000. Then these things is coming from financial accounting or accounting for profit or loss on disposal. We and your financial reporting and financial accounting for profit or loss on disposal. Optimistic. Please, can you calculate it for better understanding? I've given you all the formulas and principles, so we are just applying it. Optimistic, we are just applying. Can you use your full name next time? Optimistic, use your full name next time. So we are just applying the principles, Mr. Optimistic. And even if I had met you face to face, I would have allowed you to just be calculating and I'll be just walking through and then looking out for your answers. I always want to allow you to, to rack your brain. That's what I always do. So you have all the principles. You know how to account for disposal of PPE. That's what we are applying here. And you know how to account for the carrying value. You know how to account for revaluation surplus, how to calculate depreciation. And no one I applying in kakra. So Mr. Optimistic. Luckily for you, I'm recording. So right after this, I will share the link with you. Go over again, and I think you'll be fine. You'll be very fine. So, and luckily for you, I've given you all the steps and at every stage. Assets account debited with 6,000. Revaluation account credited with 6,000. That's for the first revaluation, right? And then asset account credited with 4,000. That's the revaluation surplus. No, the 4,000 is depreciation, right? For the 2018 year. And then we also have accumulated depreciation of 4,000. And then we have the new depreciation 12,000 divided by 3 to get our 4,000 carry value of the steps. So as soon as you finish reading the question, the various things that you have to calculate, I've given all of them to you. All of these things I think we've gone through. I've asked you and you've given me all these answers before, but they are all here. So that is it. You can go over the video and then also try doing it on your own, and after everything you compare it with the solution here. So you're supposed to try this on your own. So can you take a screenshot of it? Take a screenshot of this. You're supposed to try it on your own. Just take a screenshot and let me move on. Or should I give you some time to work and give me the answer? How do you want to do it? You want to do it later and then give me the answer next week, or you want to do it now? You want to do it now, or you do it later and give me the answer? Later. Okay, then take note of this. I'll take the answer next week. Even if the answer is here, I'll take it off before giving you the slides. The answer, okay, good. The answer is not here. This is your individual assignment. This one, you do it handwritten. I want it handwritten. Do it and then give it to the class rep. Give it to the class rep before next week, Thursday. Give it to the class rep by Wednesday, and then I'll tell the class rep what to do with it. So I want it handwritten, give it to the class rep. I want to receive it before our lecture. So I think by Tuesday, by Tuesday, when you go for the tax lecture, give it to the class rep, and I should get it before Thursday. So handwritten, this is the individual assignment one. I want it handwritten, in pen typed, handwritten. So by Tuesday, you should submit it to the class rep during the tax lecture. Submit this to the class rep. Let me get it before our lecture. So I want to go through your answers. So you have 2 assignments. This one, you are doing it. The first one, you are doing it in your notebook. Then the second one, handwritten to be submitted to me. Additional information. Okay, the assignment. This additional information. Don't worry, I'll give you the slide so you will definitely get it. There's some disclosure requirement for IAS system. What should you disclose as far as IAS system is concerned? You have to disclose the measurement basis. You have to disclose the depreciation method used. You have to disclose the depreciation rates, the useful life, the beginning and ending balances, as well as accumulated depreciation and impairment losses on various assets. And then you also have to disclose your accounting policy. That's the measurement basis, okay? Whether you're using the cost model or you are using the evaluation model, and so that base you have to indicate it. Then reconciliation of carrying amount to any additions, disposals, etc. during the period. So if there was any reversals you have to make here and there, all these you have to disclose it in the notes to the account. Okay. If there is revaluation, the date of revaluation, basis of evaluation, how did you do the revaluation? Was it by an independent valuer, or you just sat in your office and you revalued your asset? How did you do it? You have to document all of this and show it in the notes to the account. The methods and techniques that you use for your revaluation, the assumptions that you made in determining the fair value of the asset should all be documented and disclosed in the notes to the account. The carrying amount of the item being revalued, the details of changes in the revaluation surplus, all of these should be shown. So that is IAS 16. Any question? Otherwise, you have 2 assignments, one in your notebook and the other one to be submitted on Tuesday to your classroom. Any question for Beatrice? Otherwise, call it a day. Any question for me? I'm recording it, so let me, right after the class, I'm going to upload it and then I'll share the link and then the slides with the class rep. So, class rep, send me your email address, okay, via WhatsApp. I'll share the slides and then the link with you. Please, will next week be online? Yes, next week will be online. And next week will be online. I'm currently unavailable for the face-to-face, but as we proceed, a lecturer will meet you face-to-face to treat some of the topics, but I won't be available for the face-to-face. So I decided to use this medium to at least meet you and interact with you and then see what I can do. But how was it? Was it cool? Was it okay? Did you like it? Did you like it? Okay, and luckily for you, I've recorded it and I will also share it with you. So double blessing. You can watch it over and over and over and over and over. Yeah. hopefully I will meet you. I will definitely meet you. I don't know if you guys know me. I mean, I was always in the exam hall. At a point, I was pregnant with my belly all over. I don't know if you recognize me. I am that person. You always saw me in the exam hall. In Tehemia. So I'm Beatrice. You see me very soon. Yeah. Me na menyim na mefuka kakra no, yeah. Yeah, baby is doing very well. Baby is hey, someone make a can let me stop recording. Hey, mo. This thing will be on the internet too. And I make a can and so where do I stop recording?